Okay, so very good evening to all of you. I can see that few of you are visible on query list. So very good evening to all of you. I hope I'm audible to all of you. So we are starting with this topic of concept of money demand. This is your chapter number 3, and the topic is concept of money demand. So basically, first and the foremost, the layout of the this deliberations will be first and the foremost to make you understand that why this topic has been given in your syllabus, number one. Number two, what is the context? And number three, what are the theories which are supporting for this money demand? So you may think that money demand is a very common topic, but there are certain components which are very important to understand. For example, we say that what is money? Why do we need money? What are the different functions of money? Number three, that what are the factors which leads to affecting the money demand? And number four, you see that inflation is increasing, not only in India, but US also. The inflation rate is 8% to 10%. In the last 40 decades, it has led to four decades, it has led to high inflation rate and how it affects the money demand. So we are going to share today about this, all the intricacies of money. And this is the first chapter to take you forward from here. Then we'll talk about money supply, and then what are the money multiplier factors, what leads to change in the interest rates and all those things later. Okay, so first and the foremost, we are starting with money demand. What exactly is the concept of money demand, and how it what are the factors which leads to affecting the money demand? So all of you have money with you, isn't it? But what exactly is money? Money is having four major parameters. Number one, we use it for medium of exchange, isn't it? So you can buy any commodity today by paying X amount of money. So that's the first function. So it is a medium of exchange. This is known as money as a mode of transaction. And how is it helpful? Because in prior, what used to happen, you see prior how people used to transact. So if you want to buy rice, and if you had apples, it was very difficult to transact because one person wanted to have rice, but the other person doesn't want to have apples. So this coincidence of want, this is known as coincidence of want, which was lacking in barter system. Two people should have the same want or exchange of want that can lead to exchange of transaction from apple to rice, from rice to apple. But now it has got simplified because money is in existence. So money is a medium of exchange. You can buy any good, any service, anything through money. So the first function of money is it is a medium of exchange. And value of 10 rupees for you will be same for value of 10 rupees for the other person. So 10 rupees remains same, isn't it? So it is a money value. So you can say that money, and if you store 10 rupees, it will remain same. So 10 rupees is a unit of account. So money has a unit of account, one function. Number two, money has a store of value. 10 rupees, you keep it today yourself and take out after 5 years, it will remain 10 only. It is not going to become 100 or 50 or something. So it has a store of value. Number three, we have shared it is a medium of exchange. What do you mean by medium of exchange? You can go for buying anything. So that is a medium of exchange. Unit of account is what? Every commodity, any service has a price attached to it. That is known as unit of account. So you can measure any commodity or service today you buy with the help of money, which is, and the unit is unit of account. That means it has a value or the price attached to it. Okay, so this is the basic function. Store of value means the money can be stored, which will remain same over the period of time. Number five, it can be used as a deferred payment. Deferred payment means you go for taking loan today of 1,000 rupees and you can pay in future 1,000 rupees. Obviously, somebody will not go for charity, but if you're taking it from your friend, you will be refunding back 1,000 rupees. So 1,000 rupees today, you take 1,000 rupees, you give back. That is deferred payment. So what are the different functions of money? Money is a medium of exchange. Exchange, you can buy any good or service. Money, it is a unit of account. Unit of account means it has a price component. Any product you can go for buying with a specific price, unit of account. It has a store of value. Store of value means you keep 10 rupees today, it will remain 10 rupees tomorrow, store of value. So you keep money today, tomorrow, you see the number of layoffs are going up, jobs are not there in the market. I should not say this to on a pessimistic note because you are aspiring students to get good jobs in the market. But if you see that the market may go down and jobs may not be there, so what people do, they save money, isn't it? They save money, so store of value. So you keep money in locker, in bank, anywhere. So that is store of value. Okay. Number 3 is that money can be in the form of stock. Stock means you can buy shares, you can invest in bonds, you can buy gold, you can buy house, you can buy property, but these are as close to money, not exactly money. Why? Because it may have a depreciation value, it may have risk attached, it may have, you may not get the same value which you have. So 100% convertibility is not there, isn't it? So these are the benefits which you have with money. But what is the limitation of money? Money as such, if you have 500 rupees, if this would not have been with the basic norms of, as per RBI norms, money which should have the a symbol of Gandhiji and all those things, then it has no value. It is simply a paper, isn't it? So money with intrinsic value, money has no intrinsic value as such. It is money as paper has no value. It is valued because it has a price attached to it. So that is about the money with the intrinsic value. Money, a rupee has no intrinsic value because you do not get any single penny if it is a paper, simply written 10 rupees or 20 rupees or 100. Since it is endorsed by RBI, that is why it has a value attached. So money with intrinsic value is which one? Gold. Gold, when you go for selling in the market, gold has its own value, silver has its own value, but money, rupee as such, has no intrinsic value except the fiat money, which is a legal tender. So that is why the term depicts about fiat money or token money or legal tender. This which you see at the bottom here. So if you see here, legal tender with no intrinsic value. So that means the money represents a certain value which has no intrinsic value built in this. That's the difference. So I hope you understand what are the functions of money. Money is a medium of exchange. We have already shared. Money is used to pay for goods and services. It eliminates the double coincidence of want. Rupee can be exchanged for rupee. Loan taken in rupee can be paid back in rupee terms. You want to enter in purchase one transaction and want to enter for sales another transaction, it can be done in terms of money. So that means money eliminates the need for double coincidence of wants. So apple and oranges or wheat or oranges, you need not have that kind of complexity in terms of transaction. That is how money brings ease in terms of exchange of goods and services. Number 2, store of value. Store of value means it is asset, no? It can be an asset for you people. So you can keep it with yourself and you can take care about your future contingency. You can think about my health in future. I want to safeguard my health. I want to buy something in future. So you can have a store of value of money. So that is the second. So 2 core value of money is medium of exchange and store of value, that you should understand. Okay. And it is different from any other store of value because store of value for money will remain same. But in the case of stocks and others, you see how Adani prices, stock prices have gone up and down, and respectively what has happened to Silicon Valley Bank and other. Today we see about Nestle, they are talking about Capital Foods. Companies are looking for buying that. This is about, so the Capital Food prices or the Nestle prices are going up and down of the stock prices. So this Yes Bank prices, stock prices have fluctuated. So this doesn't happen with money. So money has a store of value and you can go for purchase and sale transaction at different point of time. I hope it is clear. So land, houses, bond, all these have storage cost. You have to, if you keep gold in locker, you have to pay fees to the locker fees to the bank. If you go for bond, then in that case, it may go for, you may get returns lower in the future or may get higher in the future. So risk is the factor. Apart from that, house, if you buy, there's a depreciation value. So storage cost is there, lack of liquidity problem may be there, depreciation value may be there. These kind of uh, problems you can overcome by going for money. So that's the plus of money. Money is a unit of account. I've already shared. You take loan, it has X amount of price attached to it. You have taken 3 lakh rupees loan. So that is the amount attached. That's the price attached to it. You buy something, that is the price. So it is a unit of account. It facilitates pricing. You can come to know about that. You understand the value of money. If the price goes up, that means the value of money is going down. Your purchasing power is decreasing. That's what we call in other terms as inflation. You can exchange goods and services. So you can buy goods. You go for selling your old mobile and you buy a new one. So for old mobile, they do not go for old mobile. They quote a price of that old mobile, isn't it? And according to that, they adjust for the new mobile. When you go for true value to buy a car, then in that case, they value the old car. Price is quoted to that. So that is known as unit of account. Standard of deferred payments. Standard of deferred payments I've already shared with you. What is standard of deferred payments? You can pay in future. So the credit transactions which happens in the market today, you go for investing today, you get returns in future, isn't it? So all these factors are related to standard of deferred payment. So these are the 4 functions of money. Okay. So functions of money are clear. Then what are the basic characteristics of money? Money, as we know, is the most preferred way of acceptance by people. So you say that I'll pay you in terms of gold tomorrow. People may be hesitant because gold prices may change. You say that I'll pay you in any other commodity. People may hesitant, but money is acceptable. Money is durable. You can keep money today. Credit card and debit cards are the, or you say digital transactions which you can go is also money. So money is durable. It is effortlessly recognizable. So anyone can go for accepting because it is a fiat currency. It cannot be easily reproduced. You cannot have counter currency or fake currencies in the market, which is so probability of risk can be lower. Elasticity of supply. Elasticity of supply, RBI can decide about that how much money should we have in the market. Should we go for printing more currency? Should we go for controlling the money supply through. So, for example, you see that during 2008 crisis, I hope all of you have studied that. At that time, what happened? There was easy money. So money supply increased in that market. Why easy money? Because people were hesitant to spend money and people were not spending. So government wanted to promote and that had to be promoted through ease of money. So ease of money depends upon when government wants to go for. Okay, so Mohit is saying something after some money also lost its value. See, Mohit, the money which you're saying is lost, has lost its value is unit of account we have shared, no? It will be 10 rupees, but the purchasing power changes. So that is the impact of inflation, isn't it? So that's the, but 10 rupees will be 10 rupees all throughout. It's not going to change. So that is about. So portable, you can carry money easily from one place to other. When you go for house, you cannot carry. Stocks nowadays, it's more easy because you go for demat account and others. So certain features you'll find others also very close to money, but not all the features which we find in money are there in other assets which you have. Okay, and uniformity is uniformity. That means anyone have that is same, irrespective of Tata's, Birla's, or a small vendor. So it remains uniform. Divisible without losing value. So 10 rupees can be 1 rupee coin of 10 equal to 10, or you can have 5 rupees 2 that equals to 10. So you can easily divide it and it won't lose value of that. So that is the plus of. So these are the characteristics of money. Now, the most important thing we are talking about is that why money demand is so important. Is it only for consumers? One should know about that money demand because we want to buy goods and services. You understand this is equally important for companies. So companies deciding about, I want to buy X machine. So how much is the machine going to cost? I want to go for new technology. I want to go for acquisition. How much will be the valuation? How much will be the cost? If I put X amount of money today, what will be the ROI? What will be the future value? And so on. So that is why money is important for money demand. Context is important for firms also. Money demand is also important for Difference between portable and durable money. Portable money, what you say is about that you can carry money easily. No, you put it in your pocket and you take it somewhere, or you get the debit card which says that you have X amount of money in your bank account and you can easily carry. So that is portability. So portability has become more easy today because of digital banking and other things. So that is portable. And durable is that durability of money is the money won't lose its value over the period of time, durable as compared to any other. So no depreciation. That is the durability in terms of using it over the period. So 10 rupees 10, but yes, you say about value of the money decreases. That is because of inflation. Okay, so portability and durability. Portable is all e-wallet, your e-wallet, Paytm, BMAP is all about portability. So portability has gone up. So that's money only, no? But and durability is that it is more reliable and durable as compared to any other form. Whether you talk about bonds, whether you talk about shares, whether you talk about any other form. So that is how durability in terms of money which is there. So where were we? So demand for liquidity or store of value, I've told you. So see, one interesting factor is you can store of value. We have shared two components of money functions. One is transaction or the exchange, and other is store of value. Store of value. Why do we say store of value for money? Because you want to save money for future. You want to go for investing that money. You want to create money out of money by going for wealth creation. So that is store of value. So store of value is different than transaction value. Okay, exchange, money as a medium of exchange and money as a store of value. That is very important to remember because we will be sharing this when we will be talking about theories of money demand. So the first theory proposed was classical theory. Classical theory of money demand, or before talking about that, you should understand that money is real balance. Why do people hold money? People hold money because you want to buy goods. So for purchasing power, you want to have purchasing power in your hand. And number two, you want liquid money. Liquid money, today I want to buy something, I can easily buy. So liquidity, for liquidity, you want to have money. Number three, that you want to create assets for future. So you want to buy machine in future, you want to buy a bike tomorrow, you want to buy some, you want to go for higher education tomorrow. So you want to have money today. So you hold money for creating assets in future and generating returns in future. Money demand is also dependent on interest rates. So if interest rate goes up, suppose bank says that we'll offer you 6% interest rate or 7% interest rate on your FD. So what will you think about that? On bank FD, I'm getting 6% interest rate and I'm keeping my money with me as idle cash. What are you losing? So the opportunity cost of keeping your cash is that you're foregoing that interest rate 7%, which you can get by putting it in the FD. So that is, so if interest rate goes up, your money demand to keep will decrease, isn't it? Money demand decreases because you want to go for more investments and savings. So money demand decreases when the interest rate goes up. When the prices goes up, what happens when the prices goes up? When prices goes up, things become expensive. Things become expensive means you need more money. So the money demand goes up. So what is the relationship between price and money demand? When the price goes up, money demand goes up, isn't it? Because you need more money. So the petrol price is going up, wheat prices going up, overall cost of production going up. So what is happening? You need more salary. So money demand, you demand more money because the prices are going up. Prices going up, that means you demand more. What is the relationship between interest rate and money demand? Inverse. If interest rate goes up, what happens? You want to keep, your money demand goes down. Because why? Because cost of keeping cash is more than the interest rate which you can gain. So you want to go for investing to gain higher interest rate rather than keeping your money which is not giving you any returns. So interest rate and money demand are inversely related. Money demand and prices are directly related. Why? Because the price goes up and you need to have more money, so money demand goes up. What about income? As your income increases, so Ambani's they have higher money demand as compared to poor people, isn't it? Why so? Because they have a higher income level. So higher the income in the country, higher is the money demand. As the country prospers, so US people, they spend more because they have a better level of income, so they may be spending more. Similarly, rich cities in India, they will be spending more because they have higher income. So income, as the income increases, money demand increases because your consumption pattern drives more. That's why you see higher the income, people want to buy Apple iPhone, which may be costing you 70,000, 90,000 or 80,000. That means you need more money demand. So as income increases, money demand increases. So what's the relationship we have established here? Interest rates and money demand are inversely related. Why? Because the opportunity cost of holding cash is more when the interest rate goes up. So you cannot afford to go for foregoing that interest by keeping cash. So that's why money demand and interest rates are inversely related. Prices and money demand goes hand in hand. If the price increases, money demand increases. If income increases, money demand increases. So that's the relationship of money demand and these factors. That's why it's very important to understand. Then monetary policy framework. So RBI has to decide about, shall we go for increasing repo rate or not? That depends on how people are spending. If money demand increases, that means it is pulling prices up. Prices goes up, that means inflation will be difficult to handle. So RBI will go for increasing the interest rates. And if we have studied, if interest rate increases, then money demand decreases. So to control inflation, what RBI will do? Will go for increasing the interest rate. Okay, so it helps, the money demand also helps RBI to frame its monetary policy framework. That shall we go for increasing the interest rate or not? Shall we go for decreasing interest rate? How the money demand can be controlled? How the money demand can be promoted in the economy? And respectively, they take a call that repo rate should be increased or repo rate should be decreased. Then liquid money demand depends on what? More and more liquid you want to keep when your economy is growing, when the degree of financial innovation goes up. So you have more innovations, then in that case, that's why you see today how much transactions we are doing today because of e-wallets today. You can transact in fraction of a second and you do not think twice also. So what's happening because of this e-wallet and e-commerce and other payment gateways which you have, ease of transactions, you are transacting more frequently. Transacting more frequently means your money demand is higher and higher. So this has resulted in more money demand, and that is leading to more price increase in the price level because money demand is increasing, but money supply may not increase in the same quantum, and that leads to increase in the price level. Then the next concept we have shared, opportunity cost. So opportunity cost of holding money. What do you mean by opportunity cost of holding money? So one is that you have cash. Other is that you have an option to put it in the bank or in any stock market or whatever it is in the bond market. So if you go for, normally classical economists, they took money in cash and bonds. So these were the two, because you see in the past, the other instruments were not there or the products were not there in the market. Absolutely, absolutely, Jaspreet. Money demand has greatly affected because of the ease of transactions of UPI and many other apps. So I was talking about opportunity cost. So what is opportunity cost? I hope you understand opportunity cost. Opportunity cost is if I go for, see, two things you have to keep in mind. I'm telling you repeatedly again and again. One is cash in hand, other is investments. And returns on investment, that is interest rates. So what kind of return or interest rate you get on your investments? If you forego that interest rate is the opportunity cost of keeping cash. That's the opportunity cost. So you have to always weigh that interest rates are higher. Obviously, you'll go for keeping less cash because you do not want to lose that interest rate. So opportunity cost of holding cash is higher when the interest rates are higher. And opportunity cost of holding cash will be less when the interest rates are low. I hope you are able to understand this. So this is something, fundamentals of theories of demand for money. So these are some basic factors which you have to keep it in mind. So the first quantitative theory which we are sharing today is a classical theory proposed by Irving Fisher. This theory is also known as transaction approach theory. Now, what they have taken, they have considered 4 variables. These 4 variables are, one is total money in the circulation in the economy. How much money is there in the circulation in the economy? That is M. V is the velocity. Velocity, if you can understand that how many times the amount of money is transacting in the economy. How many times or at what pace it is transacting. If the transaction of money is at a higher pace within the economy, then in that case, velocity will be higher. If velocity is higher, that means the product of total amount of money and velocity will lead to is equal to what? Is equal to price and transactions. So if the number of transactions will increase, that means the price in the economy will increase. Yes. So price in the economy increases because you see on the left side, what do we have on the left side? On the left side, we have money in the circulation and V stands for velocity. Velocity means what? Velocity means the pace at which the transactions are happening in the economy. Higher the number of transactions for one category of goods, higher will be the velocity. Higher is the velocity means higher will be the product of money in the circulation and higher will be the price because the price is equal to money in the circulation and velocity. So the price level in the economy will increase. So as I've told you people that because of ease of transactions today, what is happening? The velocity of transactions of money transactions are increasing. And since the transaction velocity is increasing, circulation of money is increasing, price level in the economy is increasing. So T stands for total transactions. So what is driving the money demand in the economy? Price level, isn't it? So higher the price level, higher is the money demand. For which motive you go for money demand? In this classical case, they have only spoken about transactive demand. So we have shared that money demand is for 2 core objectives. One can be for transaction, other can be for store of value. So what this classical economists have spoken about is only about money demand for transactive motive. And this depends on what? This depends on the velocity at which people go for creating demand or they go for buying goods and services. Okay, so this is classical theory of money demand. Is it clear to all of you? Then there's a component called demand deposits. Do you understand M1? So later on, Fisher modified this classical theory by adding 2 more components. That is demand deposits. What are demand deposits? Demand deposits are checks, you see. So banks, when you go to a bank, you create demand. That means you want to have, you write a check of 10,000 rupees and submit it to the bank. So you are creating demand from the bank based on your money, which is there in the bank. So that is why it is known as demand deposits. And velocity is about credit. So credit velocity, because you are creating the demand and the corporate are creating credit demand. So that is the velocity which may go up. If it goes up, then in that case, the total money demand in the economy will increase. So this is the concept of, okay. So P again, P is price level. Price level means inflation. Inflation means overall prices in the economy are increasing. If money demand we have shared, when you go for creating more money demand, what happens? If you create more money demand, why do you create money demand? Because you want to buy more. You want to buy more, that means you are creating more demand and this will lead to increase in price. Have you ever thought about that why price of education is increasing in India? Why the price level of education is increasing in India? It is increasing because people are creating that demand. If you create more and more demand, people are spending on education. People are spending more money on the education. So if you create more, that's one example we have shared. If you see the entire economy, then what is going to happen? If the money demand increases, the price level in the economy will increase. So that's about P. Okay, Ritika? So classical theory, as I've told you, depicts about what? Inflation. It depicts about money demand, which is mainly dependent on what? Three components: velocity, money, supply, total income in the country, and price level. If velocity remains same, then in that case, the factor which is leading income is not increasing in the short term, then in that case, only factor is money and price which goes up. So higher the money demand, higher is the price level. That's the concept of classical theory given by Fisher. I hope it is clear to you people. So keep it in mind. Fisher spoke from which perspective? He spoke from the perspective of money as a mode of transaction. Okay? Money as a mode of transaction. Exactly. So this is how it happens. Okay? So money, please do keep it in mind that classical theory, what we have shared, Fisher had emphasized on which function of money? Money as a transactive motive, or money for transaction or for exchange, not for store of value. He didn't speak about store of value. And what leads to higher money demand? What leads to higher money demand? Higher the price level, higher the money demand, or money demand pulls prices up. Higher the money demand, it pulls the prices up because velocity and income in the short term is considered as constant. Okay. Now there's another version which is about Cambridge version of money. Cambridge, this is about Pigou, who was the professor at Harvard, and he gave this concept. That's why it is written Cambridge version of money. So Cambridge version of money, if you look at, has emphasized on income plus wealth. Now wealth is what? Wealth is money from money generates more money. That means it is a store of value, isn't it? So money as a store of value. So Cambridge version of money given by Pigou says that people go for store of value because they want to minimize their risk of uncertainty in future. So people, they go for splitting off their transactive motive in two components. One is for sales and other is for purchase. I may go for selling off my house today, but I may not purchase tomorrow. But I get money in hand. And with that very money, I can buy in future. So today we can go for splitting off sales and purchase at two different points of time because of money in hand. And this is transactive motive. So transactive motive is one. Second is about store of value, which people go for. So he said about people go for transactive store of value to mitigate their risk. Mitigate means to minimize their risk in future, and that's why people go for creating wealth. So what Pigou said money demand is a function of income. Higher the income, higher the money demand. Other component is wealth. When do you create wealth? When you go for investing. And this wealth is based on interest rates. So money demand given by Pigou had three variables: income, wealth, and interest rate. While Fisher had only one parameter, that was about money demand and price level and the national income of the country. He didn't talk about interest rate or wealth. But beauty is that Cambridge gave this, Pigou gave this function, money demand is a function of income, wealth, and interest rate, but he only confined again to income only. So if you look at the formula here, money demand has a coefficient K, price P, and income Y. What is K? K is a proportion of income people want to keep. So for example, I say that it depends on monetary habits, isn't it? So for example, I say that I'm getting salary of 10,000 rupees, just an assumption. Okay. So I'm getting salary of 10,000 rupees as my income. And I believe out of these 10,000 rupees, I should keep 4,000 rupees as cash. Why do I want to keep 4,000 rupees as cash? Because I am not so aggressive spender, isn't it? So I'm not so aggressive spender. That is why I want to keep only 4,000 rupees as cash, and rest all 6,000 rupees I want to go for investing. So this K depicts what? If K value is higher and higher, what is going to happen in the economy? Money demand in the economy will increase. That means what? It is a proportion of income which people want to keep as cash. And why do people want to keep as cash? Because you want to use it for transactive motive. Transactive motive is different than store of value. So you are not worried about your future. You are not worried about your what should I say, about future security or whatever it is about your generating wealth. You're only worried about spending today. So if you are concerned more and more spending today, then in that case, K value will be higher and higher, isn't it? So monetary habits and economic structure. What you saw during COVID, what happened during COVID? During COVID, K was higher or lower? What happened during COVID? K was higher or lower? Anyone here? Anyone want to share? So during COVID, people of their income wanted to keep more cash or less cash. Are you getting my question? I'm not getting any response from you people. Okay, so what happened during COVID? If you understand that COVID period, people were scared. I lose my job. God knows what's going to happen in the future. The job will continue or not. So people started. Transactive value means spending and store of value means save. Absolutely. So what happened? People started saving more, isn't it? So people started saving more during. So the demand for transactive motive decreased because people wanted to save for future. Yes, because future was more uncertain. So store of value increased and the transactive motive demand decreased during COVID. So what is the economic structure? If you feel that market is economy is not performing well, then in that case, you will go for keeping less cash and you want to save more and more. Because why do you want to save more? Because you want to take care about your future uncertainty. But if you know that market is doing very well, economy is prospering, you believe strongly that jobs will be there, good salary will be there, then K will increase, isn't it? So that's economic structure. So if economic structure is optimistic and country is prospering, then in that case, K value will increase. Monetary habits. So people in a country, those who want to spend more and more or are prone to spending, are more consumption prone, then in that case, K value will increase. And if K value increases, that means money demand in the economy will increase. So money demand increases. So this is the concept of Cambridge K, which is given by Pigou. So I hope K proportion is clear. K is a proportion of income people want to hold as cash. So basically people create balance in terms of how much to cash to be kept and how much they should go for saving or investing for the store of value. Okay. So PY is a nominal income. Why we say PY is a nominal income? Because we know P is a price level and Y is the income. So you have studied in national income accounting, nominal income and real income. So nominal income is if the price level goes up, then in that case, if you multiply it with the income, what you get is figure is higher, but actually the purchasing power is less. Yes, you know this, no? So Y is the real national income and PY is a nominal income because PY is a product of income and price. So if the price goes up, so one of you was sharing that the value of rupee will decrease because of why it happens, because of the inflation. So that is a component of P. I hope it is clear to all of you. Okay. Aditya is saying keep more cash. Absolutely, that is more value of K. Because you see, Aditya, Cash is the numerator. So higher the cash component, higher will be K value. Yes. Transaction velocity of money, once again in simple words. Okay, Sayed, the transaction velocity of money in simple words. I'll give you one example. So, for example, I say there is one house. Okay, and that house has gone for third sale, fourth sale, fifth sale, and that too in a span of, let's say, 6 months. So that is about transaction velocity of money for that particular house. Number of transactions in a short period of time, which is leading to more circulation of money at a faster pace. That is known as transaction velocity. So if the money is transacting at a faster pace in a short span of time, the velocity will be higher. Velocity is higher means the money demand will be more, because at a higher pace, this will lead to increase in the overall price level. Is it clear, Sayed? Now, the next theory, which is very, very important to understand, is Keynes theory, demand for money. And Keynes, you know, is considered as father of macroeconomics. You are not new to economics. You know that Keynes had written a book, Theory of Employment, Interest and Money. Yes? And he's also considered as father of macroeconomics. Why he's considered as father of macroeconomics? Because he brought revolution in the field of economics by changing the concept from supply-driven economy to demand-driven economy. And that is what this demand for money theory depicts from Keynesian model. So Keynes had divided motive for holding money. Why people want to keep money? Prior, we have seen people were talking, the prior economist, whether you talk about Cambridge or whether you talk Picus or you talk about the concept of Fisher, they spoke from the perspective of only one, that is velocity of money and the demand for money, that too for transactive motive. Though Cambridge model takes care about, Picus model take care about K component, which is only confining to the transactive motive. But if you see the money demand function which he had shared, he had also included wealth and interest rate, but it was nowhere mentioned in his model which he had shared. It was only confined to cash and wealth, store of value. But Keynesian model is 2 steps ahead, which has taken care about money, why people go for holding money. So we hold money because of 3 motives that according to Keynes. And you will be able to connect very well. What are the 3 motives? One motive is that you want to have liquid money in your hand. Why you want to have liquid money in your hand? You want to buy vegetables, you want to go picnic with your friends, you want to buy clothes for yourself from Myntra and whatever it is. So you need cash, no? So transactive motive. So you want to have liquid money. So liquid money, you as a consumer, you want. Who else want liquid money? So corporate, they want liquid money. Why do they want liquid money? They want liquid money for their day-to-day expenses and others, what you read about, working capital cycle and others. So they need money to pay. They need money to go for, because everything you cannot get on credit, no? So you have to have some liquid money with you. So that is the liquidity preference. So you want to keep liquid money. Apart from that, certain quantum of money you want to keep cash. Why you want to keep cash? Because you cannot go for converting your FD to cash in a short. You cannot go for converting your stock at the same price. You cannot go for selling your house. You cannot sell gold and get. So if you put money in the bank account, then in that case, you demand deposit is very close to cash. But at the same time, demand deposit also takes time. No, if you have if you want to pay cash, sometimes it happens that you may not be able to transact through debit card or something. Machine may not be working or something may happen. So in that case, what do you need? You need cash. You need some quantum of cash, isn't it? So that is the money. If you have debit card, that is as good as cash in today's certain countries. They do not practice in terms of cash. They have debit card. I won't say credit card, but definitely debit card. So it eases your transaction. So that is as good as money. So you want to keep money as liquid for unforeseen contingencies. Unforeseen contingencies means, God forbid, anything happens, I should have some money in cash with me or as liquid as possible with me, isn't it? So that is precautionary motive. So you want to keep money for precautionary motive. So one is transactive motive, other is for precautionary motive. How do you keep for precautionary motive? You can keep it in saving account. That is as good as precautionary motive. Some people keep it in PPF and others. LIC is also you keep it for. That cannot be used so easily for transaction. So what are the three motives? One is transactive motive for day-to-day needs. Other is precautionary motive for unforeseen measure. Third is speculative motive. Speculative motive is what? Speculative itself, you understand? Speculation. Speculation means you go for between liquid and cash. Mohit, cash is liquid. Debit card is as good as liquid. Why is it so? Because for cash, you can go. So liquidity depends on how easily it can be converted into cash. That is liquidity in terms of transaction. So cash is 100% liquid, but debit card is as good as liquid. Your Paytm is liquid. If you have money in your account, then in that case it is liquid, otherwise it has no value. So liquidity is at what pace and with how much ease you can convert your two into cash. That is liquidity. Okay, so that's the difference between liquid and cash. Cash is the most liquid form, followed by others which are as close as. So your saving deposit is liquid, but not as liquid as cash. Yes. So third component is speculative motive. Speculative motive is you have taken care about your transactions. You have taken care about future unforeseen circumstances. Now you are still left with some quantum of money. What do? You invest. You invest where? Where there's some component of risk. And you know if the risk is there, then in that case, returns will also be higher. So that means you're speculating. So speculative motive is which arises from uncertainties about the money value of other assets that an individual can hold. When you go for investing somewhere, you know that there is uncertainty because it is driven by market risk. You may lose, you may gain less, you may gain more, but still you go for it because you've already taken care about your transactive motive, you have taken care about your precautionary motive. Now you can go for your speculative motive. So these are the three motives for which people keep money. Okay, so that is what Keynes has given. So how Keynes theory is different from others? Keynes has further fragmented or given more precision to money demand. Money demand for transactive motive, money demand for precautionary motive, money demand for speculative motive. So I've already shared what is transactive motive. Transactive motive is you want to buy anything at any point of time. I should have money. That is about money demand for transactive motive. Trade-off between amount of interest and individual forgoes for holding money. Cost of holding small amount of money, we have already shared. What is cost of holding small amount of money? You keep cash, you forgo interest rates. That is the cost of holding money. So some people decide about what people think about. Now, I tell you one thing, or you might be knowing about this, that banks today are offering smart account. I hope some of you might have heard about this. Why banks are offering today smart account? So this smart account is about having a combination of saving plus FD. So for example, a service class person, people like me, those who want to be liquid and want to go for minimized risk. So what do? We get our salary in the bank account. No. So what we have given instructions to the bank. So we have told bank that you go for keeping 50,000 rupees in the bank account And the moment it goes over and above 50,000, you put it in FD. Because you know, saving interest rate is 4%, but FD rate you can get to maybe 5 or 6%. 6%, I'm highly optimistic. Let's say 5%. Still, you are gaining 1% more. So what do? In that case, you give instructions to the bank that 50,000 you keep it as deposit in my bank saving account, and rest all money, whatever is over and above 50,000 is there, you go for putting in FD. So this FD is flexi FD. So what am I doing here? I'm taking 50,000 for my transactive motive, and over and above 50,000 is taken care about not only my precautionary motive, but also for speculative motive, isn't it? So I'm saving money over and above. So what I'm doing here, I'm minimizing the cost of opportunity cost of holding cash. Yes, since I'm putting my money in the bank account, I'm not only getting saving interest rate, but I'm also getting FD rate, and I'm minimizing my opportunity cost of holding cash. So you can keep less cash so that you can minimize your cost and you can go for getting more return. So the opportunity cost of holding cash can be reduced by keeping less amount of cash and putting more money in the bank account. So this is the concept of trade-off between cash and getting interest rates. Okay, so transaction demand for money, you can see here LR depicts what? Transaction. LR is for transaction demand for money. You want to keep liquid money, that is why it is LR. K is the money quantum of earnings of yours which you want to keep it as cash. Y is your total earnings. How much do you get? So this is same, you can understand this is same as Cambridge P goes ratio, isn't it? So this is the same concept. Here K stands for what? The ratio of earnings which you keep it for cash purposes. So you will see that Keynes demand theory is more extensive and it covers major components, but there are certain limitations also we'll share as we'll proceed. Up to this is clear to all of you. If you have any query, you can ask. So we are sharing transaction demand for money given by Keynes, which is expressed in the form of transaction demand for money LR is equal to KY. K is the ratio of earnings, which we have shared prior also. 2,000 rupees out of 10,000 rupees. Ratio of earnings which is kept for transaction purpose. So how much I'm keeping it for transaction purpose. So let's say my liquidest degree of conversion. Yes, rupee and dollar both are money, but values are changed time to time and conversion. See, Mohit, if you go for converting, then definitely it will change because we have shared that economies are different, isn't it? So US economies, demand for dollar in the international market is different as compared to rupee in the international market. So there are other factors also which we will be sharing in Forex when we will be sharing. Okay. So first and the foremost, you should understand why we demand money and what are the implications of money demand and what are the factors which govern money demand. Okay. So this is about how much of money of your, let's say that I can say in simple words, K is 10% of the earning of mine, I'll keep it for my transactive motive, 10%. So my K becomes 10%. So 10% of my income, I'll keep it for transactive motive. Because you see, people, LR value be low in case of absolutely right, Sayed, absolutely right. If you go for more saving, obviously the demand for transactive motive will be less. So Y is the total earnings and transaction demand is related to level of income. We have already shared, you remember when we started initially, we said that transaction demand is directly proportional to income. Higher the income, you see that people, those who have more income, they buy big cars. So they buy big car means they need more money. So they buy premium car, isn't it? They buy premium cars because their income is higher, and they buy palatial houses. So because their income is higher, so the transaction demand goes up, isn't it? They spend more on branded clothes. So transaction demand goes up. So higher the level of income, higher the transaction, and in that case, K will be higher. Yes. Then precautionary motive. Precautionary motive will depend on what? It depends on rate of interest, isn't it? So precautionary motive depends on, to some extent, the payments you have to make. So you believe that precautionary motive circumstances are like that. You believe that my health issues will be there. I have to take care about that. So that's why you go for. You think that in family some contingency can be there in future. So you want to go for more precautionary motive. I'm sorry. So this is uncertain. Higher the level of uncertainty, higher is the precautionary motive. So countries like today, you see Ukraine people will have which motive more? Money demand for which motive more? Definitely precautionary motive, because they are very scared, no? Because they do not know their future, it's so uncertain. So they want to keep more money for the future rather than spending today. So they will be spending less today. So transactive motive demand will be less because their future is uncertain. And even precautionary demand also depends on how your financial system is. So today, you can go for opening your account today on your mobile, isn't it? So because of the technology, because of the advancement in the financial system, the demand for precautionary demand may increase. People may be more inclined towards saving, isn't it? So people get more inclined. The advanced systems in financial system, more advanced financial system is, more technology driven the financial system and the financial institutions are, ease it becomes for people, or rather they become more motivated to go for savings. Yes, so precautionary demand increases in that case. No, Sayed. It will not be included in K, because you see in K what we are saying, K is a component which you go for transactive motive. So whatever you go for savings will be part of precautionary motive, which you are not spending. You may have cash, but that you are not spending, that is a part of savings, which is not part of K, because it is not spent on transactive motive. Okay, so K will not include precautionary, but K is a component core about transactions. Okay, Sayed? So keep it in mind. So we have shared what is the trade-off from the transaction. So for Ukraine people, the trade-off from the transaction to precaution is very, very high, isn't it? So they can't afford to go for transaction motive, because they know that it is important for us to save our future. So then in that case, the opportunity cost is high. What is the other factor we have taken in for the precautionary motive? Demand can increase in the market. That means the transaction demand can decrease to some extent. If a country has more defined, structured, safe financial system, obviously you can go. So if you can get an option to save for 5 days, 7 days, 15 days. So why will you keep cash for 15 days, isn't it? So 15 days, if you can put money in the bank and you can get interest rate of 5%, 7%, why not to go for it, isn't it? So this is how it works. Just treat the saying APC. Okay, so yes, average propensity to consume can be one factor which can result. You cannot see directly proportional beta, but definitely K is a component which depicts about spending pattern. So in India, K will be higher. Why? Because one, we are believing that economy is prospering. Number two, thanks to you youngsters. Number three, that people after COVID have realized that some says, you might have come across this term, revenge spending. So people during COVID were refrained from spending. Now they want to spend like anything. That's why you see travel and others have gone up. People entertainment expenses have gone up. So this is happening because now K is higher in India, because people have realized that what we have foregone, we should enjoy today. So transactive motive demand has gone up. So it depends on economy, how economy is performing, and how sentiments are in the economy. That drives K up or down respectively. And vice versa will be true for precautionary motives. So like we have shared that countries which are more insecure, people feel more insecure, political instability is there, terrorism is there, uh, high inflation is there, job uncertainty is there. That case, what will happen? People will be more pessimistic, and obviously precautionary motive demand will increase and transactive demand will decrease. So I hope it is clear to all of you. Then speculative demand for money. Speculative demand depends on what? It depends on if you have well-defined uh, mutual fund system, mutual funds in India, people are aware about mutual funds. Uh, you have good asset portfolio management in the country. So what is going to happen? People will be deciding about how can I diversify my risk? How can I gain more? So it helps more, isn't it? So you have asset management companies today, what you call them as portfolio managers. Then you have something like Zerodha. You might have come. Some of you might be investing also through Zerodha and others. So you have these uh, ET Money and so many other platforms where it motivates you that I should create my portfolio. So you start investing in the market and you create your portfolio to diversify your risk. And but at the time when Keynes gave this concept, he spoke more about bonds, which is very difficult for you to connect because that time the market was not so developed. So the only thing which came in their mind was bond as an investment option with the speculative demand. Okay, so we will be sharing that more about, but I hope you can differentiate Fisher, the classical economist, which gave the money demand, which was about money into velocity is equal to price into transactions. Then given by Cambridge Pigo, which is about, I'm sorry, about K, which depicts about that how much you spend on, how much your income, percentage of income you want to spend, or the quantum of money you want to spend from your income, higher it is, which though he took care about wealth and interest rate, but he didn't speak about that. Now we are taking about Keynes. Keynes has segregated money demand for three motives. One is about liquidity, transactive motive. Second is about precautionary motive for contingency. And third is about speculative. Speculative is for store of value. Yes, speculative is for store of value because you want to create wealth. You want to create wealth by using which function of money? Store of value. So speculative demand is more about store of value. Okay, so in speculative motive, what is important? You have to analyze risk, you have to analyze yield, how much returns you will be getting in future, how much is the risk there. So you want to minimize your risk and you want to gain maximum, and you take a call whether it is worth investing in bonds or not. That depends on what? Interest rates, interest rate risk, which we will be sharing uh, in this. Any idea about bond? What kind of relationship is there between bond price and interest rates? Any idea about what is the relationship between bond price and interest rates? Any idea? Okay, have you heard about this Silicon Valley Bank? What went wrong with Silicon Valley Bank? You know, in US, Silicon Valley Bank defaulted. Anyone in the class is aware about Silicon Valley Bank? What happened? I don't think you people are reading. So what is the relationship between bond price and interest rates? Any idea about? Don't know. Yes, inverse. Ritika is saying inverse. Why is it inverse, Ritika? Any idea about why is it inverse? Bond price and interest rate. See, I'm giving you one scenario. You can note down in your register or whatever you have, notepad or whatever it is about. So I'm giving you two scenarios. Please do write down. It is April 2022. Okay. April, today, what is it? 3rd of April. No, 3rd of April 2022. The bond was issued in the market by Reliance. And it was of bond price was 1,000 rupees. Are you people writing? April 2022, 3rd of April 2022, the bond was issued by Reliance, or let's say company X. 1,000 rupees was the bond price, and the interest rate was 5%. Okay, interest rate was 5%, and it was issued. The bond price was 1,000 rupees. Okay, so the bond was issued on April 3rd, 2022. Bond price was 1,000 rupees and interest rate was 5%. Now, scenario B. Scenario B is 3rd of April 2023. Company Y wants to issue bond in the market because the interest rate has gone up. At price is 1,000 rupees and the bond issued is at 7%. Bond issued at 7% and the bond price is 1,000 rupees. Okay, written? So I've given you two scenarios. Scenario A, company A has issued a bond on 3rd of April 2022 at the price of 1,000 rupees at the coupon rate of 5%. Scenario B, company B has issued a bond at the price of 1,000 rupees at the coupon rate of 7%. Company B, scenario B is company B has issued a bond of 1,000 rupees at a coupon rate of 7%. Now this company A on 3rd of April is in need of funds and want to sell its bond in the market. And if it is given to Ketan that you buy the bond, you want to buy the bond. So if I'm a company A and I'm in need of money, so I'm selling it to Ketan and telling him that you buy this bond at 1,000 rupees, I'm giving you 5% coupon rate. But Ketan knows in the market today that another bond is available in the market, which is giving me 7% interest rate. Will Ketan buy it from me? I'm offering him 5% interest rate at the price of 1,000 rupees. But he's also getting in the market today 1,000 rupees bond at the coupon rate of 7%. Why will he buy my bond at 1,000 rupees with low interest rates? What I have to do, what I have to offer to Ketan to buy my bond? I'll tell him, see, you are getting in the market at 1,000 rupees, 7% interest rate. I'm going to offer you this bond. You take it from me at 800 rupees. So I'm offering you at 800 rupees with 5% interest rate. Now, is it possible that Ketan may buy? Yes, he'll buy. Why will he buy? Because the other bond, which is offered at 1,000 rupees, is offering 7% interest rate. But now I'm offering bond in the same market on 3rd of April at 800 rupees for the coupon rate of 5%. What's the take here? What's your learning? What's your learning? Learning is that if the interest rate goes up, bond price goes bond prices are discount. Discount means from 1000 to 800. If the interest rates are going to decrease, 3rd of April 2023, if the interest rates would have been 3%, then in that case, company A, if I, as a company A, wanted to sell it to Ketan at 1000 rupees with 5%, and the current interest rate in the market is 3%, he will happily take it. He will take it or not? Will he take it? 1000 rupees, and I'm offering at 5%, and in the market he is getting 3%. He will take it because he is getting higher interest rates. So what is the relationship here? Relationship is that if the interest rate is higher, the bond price will decrease. That is what happened with Silicon Valley Bank. I'll share it later with you. We are running short of time, so we can't go for discussing that. I would appreciate if you can read about Silicon Valley Bank, because that's something related to, they had invested in bonds, then US inflation rate increased. So US Fed Bank had increased the Fed rate, and because of the increase in the Fed rate, Silicon Valley Bank wanted to sell its bonds in the market. They could not sell because the interest rate in the market had increased. And for that, if they wanted to sell it, they had to sell at huge discount, and they had incurred huge loss. And they didn't get money through that, which they had expected. That's why they lost. Okay. Yes, good. So this is clear to Singh. I was saying, okay, so I hope all of you are clear with this concept. Now coming back to this speculative demand, inverse relationship of speculative demand and interest rates. So what Keynes said that speculative demand is a function of future change in the interest rate and the change in the bond price. People decide to invest in bonds based on two components. What is the probability of change in the interest rate in future and change in the bond price? So, and it is believed that the return on money is zero. So when you believe that money is not going to give you any return, let me invest in the market. You invest in the market based on two parameters. How much interest payments I'm getting, that is a coupon rate. Number two, what is the expected rate of capital gain? Capital gain, if I have to sell my bond in the market, then how much profit I'm going to make. If I'm going to make profit, let me buy it today. Otherwise, I'll not buy it, isn't it? After all, you are investing in the market for capital gain only. Who wants to lose in the market? So you want to go for capital gain. So these are the two parameters. I hope it is clear. So inverse speculative demand depends on what? Speculative demand depends on interest rates, because we have shared that if interest rates will increase, the bond prices will change, and respectively, your capital gain will change. So interest payments is one parameter. Number two is expected rate of capital gain. These are the two factors which decides about expected returns on bonds, and which makes people to go for investing. So market value of the bond and the market interest rates are inversely related. This is one takeaway you can take it from this scenario A and B. Yes. So the price of the bond, market value of the bond, and the interest rates are inversely related. Number two, investors have a relatively fixed conception of the normal. So what people believe, why Ketan was not ready to buy? Because he believed that the current rate, 7%, is the normal rate, interest rate I should get, isn't it? So once you believe that the normal interest rate is higher, then in that case, there can be two scenarios. If the current interest rate is greater than the normal interest rate, what you expect, then in that case, what will you think about? Today the interest rate is higher. In future, for sure, it is going to decrease, because the normal rate should not be more than 5%. If it is today 7%, which is higher than the 5% interest rate, that means you will believe that in future it will for sure decrease. Why? Because normal for you is 5%. And if the market interest rate is 7%, then for sure it is going to decrease. Yes. So if it is going to decrease, then in that case, is it worth investing in the bond or not? It's worth investing because today you're getting higher interest rate and you believe future it will decrease. So you should buy today bond, because once you buy the bond today, your future interest rate is safeguarded. Yes. So what is your learning here? Learning is that if the current interest rate is, for example, is 7% on 3rd of April 2023, and you believe this is higher than what exactly should be, then in that 5%, then in that case, what will you do? You will expect in future for sure it will decrease. And if it will decrease, let me buy today only. So you'll buy the bond today only, because you know in future it will decrease. So high expectation of capital gains makes you to invest in the bond. When will you invest? When you know that the current interest rate is greater than the nominal or the critical interest rate. This is clear? This is clear to all of you? So what is the relationship between current interest rate and the normal interest rate? If the current interest rate is greater than the normal interest rate, then in that case, you know or you believe that in future for sure it is going to decrease. And since it is going to decrease, let me invest in bonds today. Why? Because you believe that it will give you capital gains. You expect high capital gain. Yes, so this is what Keynes proposed for speculative theory. Now, if you look at here, what do you see here? This RN, what you see is the interest rate offered on 4th of April 2023, which is higher, and the critical interest rate RC is lower. In this case, you do not want to keep cash. You want to invest whole your money in bond. You want to invest your money in bond. So you will go for more of speculative. What's the take? If current interest rate is greater than the critical interest rate, then you expect that probability is that in future the interest rate will decrease and you will gain capital gain. You will incur capital gain, and that's why you invest your money in bond. That's why you see that money demand in that case will be zero when the critical interest rate is lower than the interest rate which is there in the market. So if the nominal interest rate or the current market interest rate is more than the critical interest rate or the normal interest rate, what you perceive, then definitely you'll go for investing in bond. That is individual speculative demand for money. Clear? So shall we take a break and then go for it, or you want me to continue further with this? Okay, so speculative demand for money. 2008 crisis, if you know about 2008 crisis, what happened in 2008 crisis? You have studied, no? 2008 crisis. What happened in 2008 crisis? What was the interest rate offered in US at that time, 2008 crisis? After that, what were the sentiments in US economy after 2008 crisis? People's sentiments were that economy is not going to recover, and US economy is in such a scenario that it will not recover. People lost all trust and faith, and the transactive demand for money decreased. Precautionary demand for money increased to that extent that people were not willing to spend only. And since people were not spending, that means if you do not spend, you do not create demand. You do not create demand, why the corporate should produce. So corporate were not producing, and corporate were not producing means they were not investing. Since they were not investing, that means they were not creating jobs. So jobs were not there, investments were not there, consumption was not there, and economy was suffering. So what US did, US Fed Bank did, they decreased interest rates. Now, once you start decreasing interest rate, ideally, what is expected? The cost of borrowing decreases. You get easy loan. That means you will spend more. You will spend more. That means corporate will produce more. Even corporate cost of borrowing will also reduce. So they will also be motivated to invest. And so investments will increase. Economy will be back on track. But did this happen? This didn't happen. Why it didn't happen? Because people had lost trust. They believed that the economy will not be back on track. So what US did further? US further decreased the interest rate. So interest rate from R1 to R2 to R0. So interest rate was decreased to that extent. But people were not willing to spend because people thought that interest rate will not go beyond this, will decrease beyond this. And if we invest today, what's going to happen? What we had shared, the current interest rate should be greater, no? So that you can gain. But if the current interest rate is less than what you believe, will you invest in bonds? You will not invest. So people lost all trust despite interest rate going down. And they were caught in liquidity trap. Liquidity trap means they were not ready to go for investing their money and they wanted to keep whole lot of their money in cash. This is known as liquidity trap. What is liquidity trap? Liquidity trap is zero inclination to invest in the market. Why? Because you believe that interest rate is so low, it won't further go down, and in that case, you will incur capital loss. If you go for investing, you will not gain capital gain. You will lose. And because you will lose, you do not want to invest in bonds. If you do not want to invest in bonds, as per Keynes, there are two options. You invest in bonds or you go for keeping cash. So people will keep entire money in cash. And they're trapped in that liquidity because they have lost all hope. This was the concept given by Keynes as liquidity trap, which was very evident in the case of 2008 financial crisis, which happened in US. People were not investing despite interest rate going down and down because people had lost all trust. So this is liquidity trap concept. Is it clear to all of you? Anyone want to ask anything? Is it clear to all of you, liquidity trap? This is what happened in US, global financial crisis 2008. Short-term interest rate went to zero. Interest rates were zero. And this led to liquidity trap because there was no opportunity cost of holding cash. So people knew that if they are keeping cash, they're not going to lose anything. And since they were not losing anything, then why should they invest? Why people invest? People invest only when they believe that there's an opportunity cost of keeping cash, isn't it? So you do not want to lose 5%, 6% interest rate. That's why you go for investing in the bank. I've already shared smart bank account because I know I can get money. Okay, so good. So it's clear to all of you. Mohit is saying to take break. You can you want to go for break for 10 minutes and we can resume back after 10 minutes. So it is 7:30 and you can come back by 7:40 so that we can go ahead. Okay. US government increase interest rate more than needed, then what would have happened? Very valid point, Sayed. See, if you are in an economy where things are not good, and we have shared during COVID what happened, people were not investing, people wanted to go for precautionary. When economy is in a crisis, then people go into that zone of saving. Corporate, they are hesitant to invest because they know if we'll invest, people will not buy, our inventories will pile up and our money will get stuck. So corporate, they do not want to invest. Consumers, they do not want to buy. And if interest rate further goes up, what is going to happen if interest rate further goes up? Corporate cost of borrowings will further go up. That means if they were investing marginally also, they will not invest. So further it will hamper investments. What about consumers? Consumers, they can't afford to put money in banks because they know that future is uncertain and we need to have cash. And they were not having enough cash also because they lost their jobs. So where to invest, where to go for saving? So government at any cost or federal bank could at any cost were not in a position to increase interest rate. They had only one option to gain trust of people in US to decrease interest rates. But that also didn't help. And that's why they had gone for quantitative easing 1, 2, and 3. If you have studied this 2008 crisis, subprime crisis, because I can't share it from scratch. We will be left behind to cover topics which are there in this chapter. So I'm only giving you reference considering that you people know about this 2008 crisis, what happened and what was the status of interest rates and why despite of lower interest rate, people were not investing. Why people, you know that people at that time invested in Indian stocks, but not in US, rather Indian banks stocks, because they had more trust and reliance on Indian financial system than their own country. Despite offering at a very low interest rate, they were getting money and everything, ease of money, but still people were not going for it. So that's why people were keeping more cash and no monetary policy was helping them. But gradually, when government started pumping money and people started gaining trust, and then economy came back gradually on track, and then they gradually started increasing interest rate, and then people started investing back in the economy. This is how it happened. This is a real case of US economy after 2008 crisis, which is a classic case of liquidity trap, which you can study. If you people have studied about this. So we'll share about next concept, Baumol's theory of inventory approach of money demand after break of 10 minutes, I believe so. Yes. Okay. So I hope Keynesian theory is clear to all of you. Now we are heading towards the next theory, that is inventory approach to transaction by Baumol. Okay, this is also known as cash balance approach, and this takes care about two parameters. So one is about, it is about money, and second is about interest bearing. So Baumol has created a portfolio of two things, cash and bond. Okay, but there is one more feature you will find in this theory, which is about brokerage fees. And which, see, when you go for buying a bond, when you buy any mutual fund services, it's not offered free, no? They charge certain fees from you. So that's a cost. So, and when you switch over from money to any kind of investment option, you incur certain cost. That cost is fixed when you go for transacting from one to the other. So there's a fixed cost of making transfers between this. So this is the fixed cost component, which you see over here. Fixed cost of making transfers between money, and the alternative is brokerage fees. If you do not go for investing, you're foregoing that much of that. That is a fixed cost. And then you have alternative cost, which is involved of brokerage fees cost, which you have to pay for transferring. So he called this carrying cost. Carrying cost is the cost of not investing and keeping your cash rather than investing in bonds. And other is a brokerage fees. This brokerage fees is the cost, is the opportunity cost. Brokerage fee is the cost which you incur because you go for from cash to bonds. The more frequently you transact or you transit from cash to bond, higher will be your cost. Higher the brokerage fee you have to pay. So this, to minimize that, what you have to do, that you should not lose by keeping cash and losing that interest on the bond. At the same time, you should not incur high brokerage fee in transiting from cash to bond. You have to balance in such a manner that your gain from investments is more than the cost you incur or the opportunity cost you forego. This kind of minimization of your cost and maximization of your gain is known as optimization portfolio creation between cash and bond, which Baumol theory has proposed. That is why it is also known as inventory. Why this is known as inventory theory? Because you see that how companies, they decide about their inventory. How do they plan their inventory? Let's say that if a company has planned more of inventory investments, okay, so they go for more of inventory creation and their store is full of stock. So they have invested in that inventory. But the problem is that they have invested and now customers are not coming. What's going to happen? Inventory is there. So the cost of inventory they have incurred, but they are not getting customers. So that means they are not generating revenue. Since they are not generating revenue, the cost incurred is fixed costs, which they cannot overcome. Now what they can do, what they should plan for that. Now they have to dispose of that inventories. That's why you see that companies, they offer sale discounts, 30% discount, 50% discount when there's a transition from one season to the next season. Why do they do this? Because they cannot go for piling up their inventory cost. So that's the cost they incur from transition from the inventory stock to losing revenue or incurring high cost. Similarly, people, those who have money in cash or those who have money, and the other is that the alternative financial investment option they have in hand. So they have to make a kind of balance portfolio which comprises of cash and bond. So they have to make an optimum combination of cash and bond, which helps to minimize their opportunity cost of holding cash and not investing in bond, at the same time minimizing their brokerage fee cost, which they have to incur by transacting from cash to bonds. Are you getting me? Is it clear to all of you? This is what has been proposed by Baumol. So it is why it is known as inventory, because the way companies have to manage their inventory, they have to optimize their inventory in such a manner that they should not lose their customers. At the same time, they should not incur cost of investing more in inventories and not getting right kind of sales. So similarly, people have to go for optimization or optimum combination of cash and bond in a manner which helps to minimize their opportunity cost of keeping cash, and at the same time help to overcome the brokerage fees and result in capital gain. This is Baumol's model, inventory analysis. Is it clear to all of you? So how is it different from what Keynes had proposed? It has included the component of brokerage fees, which Keynes didn't speak about, and the trade-off by interest income. So interest income component, which was not taken care prior, has been taken care in this theory. So Baumol's theory talks about store of value of money and cash. So it emphasizes more on store of value. That's why it talks about creation of balance between cash and bonds. Okay, is it clear? So in the real world today, which is not only about bonds, because what Keynes said about bonds is the only option as investment. But today in this world, you have other investment options also. So short-term financial assets, like you can invest in treasury bills, you can invest in long-term bonds, where the returns may be more uncertain. But these were not considered majorly because they confine themselves to bonds only. So money holding is not going to pay interest. We know that. You keep cash, you do not get any interest. If you go for bonds, you get interest rate, whatever may be the interest rate, 5%, 7%, 3%, 4%, but you get a nominal rate of interest. And if you go for keeping cash, you incur cost. If you go for transacting from cash to bond, you incur transfer cost. This transfer cost is also known as brokerage fees. So you have to minimize your opportunity cost, you have to minimize your transfer cost, and you should look for gaining by investing, at the same time creating right kind of cash portfolio balance between cash and bond. So this is also known as cash and bond balance or inventory theory. Okay. Because you see that investments, you go for income, you get in one go, no? Income you get in one go. That is your income which you get in salary form, which is maybe cash or whatever it is about. But expenses you incur over a period of time. And that is why this portfolio management becomes a little challenging, because you cannot define all your expenses in a very predefined manner that these will be my expenses and for this much cash I need, and rest all I will go for investing in bonds. That is why it is sometimes challenging to create a right kind of balance between cash and investments, because your expenses are not so certain. And that's why you incur that transition cost of the brokerage fees and opportunity cost. And that is why this carrying cost of holding money increases. So you keep more money in hand, you increase the opportunity cost, you incur more opportunity cost, and you lose your profits. So you want to minimize that, and for that you have to take a decision. So this talks from more behavioral perspective, isn't it? So you have to be more You have to think about this, that how should I balance my cash and bond portfolio so that my carrying cost of holding money should not increase, and at the same time the brokerage fee should not increase, and my returns or the profits from my bond net profit should increase. This is Baumol's theory of bond and cash. So he spoke about what? He spoke about two cost component in money demand. One is the cost of is anyway lower than the opposite. So we should go with investment instead of holding. See, Jaspreet, we have shared, and as you know, that certain times what happens, inventory, that is why it has been connected with inventory. Can you in a business will always be certain about that this is what my customers, this much quantum of goods or services my customer will require. And that much only I should go for inventory. It always happens. Your inventory sometimes runs short of what your customers, because you two are different players, isn't it? You are the supplier who is catering to your consumers, and consumers are creating demand. It may not be possible that you are on the same platform. What the consumers expect that, or their pattern of spending may be different than what the investor or the producer decides about. So I tell you one example. When this Fiat was in production, Fiat car. So Fiat car was in production and gradually it was losing its market segment. And Fiat manufacturer or the producers, what they did, they kept people on hold for 6 months to 7 months, despite booking the car. Reason being, they never wanted to pile up their inventories. And the cost would have exceeded like anything. So they started making based on the demand. They didn't pile up their cost in terms of inventories. So that is why. So the first cost is interest rate of money, which you may forego by keeping cash. Another is a brokerage cost. So these are the two cost components which Baumol highlighted about. And that is why the cost component has to be always minimized and gain should be maximized. And for that, you have to create a right kind of portfolio which can help. And why this is challenging, I've already shared. Income you get in one go, but expenses are recurring and uncertain. And that is why it is very difficult to decide that this much quantum of cash to be kept and this much to be invested in bonds. It becomes a very tricky thing. And that's why you incur cost in terms of brokerage cost and opportunity cost of keeping money in cash. So the most important contribution of their theory is that interest rate influences transaction demand of money. Because if interest rate will go up, your opportunity cost will go up. Opportunity cost goes up, that means you want to go for more investments in bonds. If you invest in bonds and if the interest rate fluctuates quite often, then in that case, your brokerage fee will also go up. So the most important factor which Baumol introduced was interest rates and connected it to transaction demand of money, which no other economist had done in the past. So that is how his theory was different to some extent with others. Then Milton Friedman is a new generation economist, if you know about. He introduced very important terminologies here. So what we have shared till now, assets were only about bonds, isn't it? So prior all theories spoke about you keep it cash or you go for investing in bonds. That's it. But Milton Friedman introduced 5 categories of asset classes. These 5 categories of asset classes are money, obviously money you keep cash. You can go for bonds, we have already shared. You can go for equity. You can invest in stocks. You can go for physical capital. You can buy house. You can buy something, basically house or land, physical capital for people like us, and human capital. You work on your skill, education, other factors, human capital. So that is also asset. So this was unique about Milton Friedman. He took care about 5 categories of assets: money, bonds, equity, physical capital, and human capital. These were the 5 categories. And number 2, he spoke about demand for money. Now, Keynes spoke about money, or prior people spoke about money from which perspective? Nominal income, isn't it? Nominal income, because we had multiplied price into Y, price level into Y. So it was nominal income. But Milton Friedman introduced permanent income. What is permanent income? Permanent income is the income which is not only what you get through a salary, but the income which you can get by investing. So if you invest, future expected returns is also part of your income. Future gains which you may gain by higher education, you may get higher salary. So that is also your income. So he took care about permanent income. That is one variation from prior theories. So Milton Friedman said that demand for money is not based on nominal income, but it is based on permanent income. Permanent income is the income which is not only comprises of your nominal income, but it also comprises of income, expected gain, or expected income, or expected returns which you get through these categories, which can be money. Obviously, money will not give you any kind of return which is core of nominal income. Then bonds can give you, equity can give you, your house can give you rentals and others. Human capital by your skill and education can give you higher salary. So these are future income which you can get, and this adds on in your permanent income. And this permanent income is then taken care by discounting. You know, no principle of discounting. So this permanent income permanent income is not only return on investment, it is also money. Please do remember, permanent income is the salary which you get plus return on your investment. That's why money is one of the asset class. So money is there, which is your salary or pocket money or whatever you say about. Apart from that, returns on your expected returns on your investment, expected returns, not actual expected returns. That is a permanent income. And then we go for discounting it. Obviously, when you're talking about expected returns, so you have to go for discounting only. God knows inflation will go up or down respectively, isn't it? So this is Milton Friedman money demand theory. So what is the basic variation? One, he introduced demand for money with respect to permanent income, rather than prior economists spoke about nominal income. Nominal income was P into Y. Milton Friedman spoke about or propagated about permanent income. Permanent income is the income which includes income from salary and other, plus relative returns on assets, expected return on assets, which has to be discounted by the discount rate, whatever, so that you can know the expected return. That is how you calculate no returns. So this is how Milton Friedman demand is more refined, I would say, in today's context, because asset class cannot be confined only to bonds, which we have shared till now. It also includes equity. People invest a lot in house and real estate, and people today are investing a lot in education. So these are the factor asset classes which were included by Milton Friedman. And you already know that we have shared higher the price level, higher the money demand. Yes, because the price increases, you need more money to buy goods. So the money demand goes up. And that is true in this case also, Milton Friedman case also. So if price level will increase, money demand in the economy will increase. So it is positively related. We have been sharing this right from the very beginning. We have shared that interest rates and the money demand is inversely related. This I hope is clear to all of you. Then the next is opportunity cost of money holding declines, hence money demand increases. If If you get high returns on bonds, then in that case, what will happen? If you get high returns on bonds, then in that case, the opportunity cost will be high. If the opportunity cost is high, then in that case, if opportunity cost of holding money declines, that means you want to go for keeping more money in cash, no? Because you are getting less return to, so you want to keep more money. So opportunity cost of holding money means what? Returns on bonds are decreasing. If the returns on bonds decreases, then you want to keep more money. Demand. So you create more money demand. We have already shared this. If inflation increases, then what happens? If inflation increases, opportunity cost of money holding increase. Its opportunity cost of money holding increases, no? Because if inflation goes up, then in that case, obviously the interest rate will go up. Interest rate goes up, then the opportunity cost of holding cash will increase. So this concept, so he connected with what? He connected with 5 assets, but majorly he spoke about the relationship between demand for money and interest rates. So this is how it varied. By introducing speculative demand for money, Keynes said about what? Keynes made a significant departure. So if you look at progression in money demand theory, we started with classical. Classical theory spoke about what? Money demand and price level. When we switch over to cash balance approach took care about balancing between cash and bonds. When we spoke about Cambridge K, what was it about? Cambridge K by Pigou was about what? That transactive motive. Store of value was given by whom? Given by Keynes later on when he spoke about speculative motive. So as we have transited from the classical to Keynesian to Baumol's theory, we have transited or progressed from bonds to assets of 5 categories. We have taken care not only about risk, but we are talking about returns also. So we are not only talking about risk, but we are talking about returns also today. That is the progression in theory of money demand theories over the period of time. What were the drawbacks of Keynes' theory? Keynes only confined himself to bonds. He didn't take care about any other asset forms which are there in the market, like shared by Baumol, by bonds, even human capital, physical capital, and so many other components. So this is how it varied over the period of time. So portfolio of wealth consists of money, interest-bearing bonds, shares, and physical assets. Now the next is Tobin. Tobin and Baumol theory is almost closely related. Here, Tobin spoke about why people want to keep money in cash. When people are scared about risk, they want to keep cash. So if people are more risk averse, people are scared of taking risk, they'll prefer to keep more cash. As people become more risk takers, that will make them to go for investing. So that is how Tobin's approach was towards money demand. So Tobin said that investor is faced with the problem of, you as an investor, what is the biggest problem you feel when you want to invest in the market? What proportion of my portfolio of my financial assets should be kept in the form of money, which will give me no interest, and others which should derive me interest-bearing bonds. So what kind of risky assets should I have in my portfolio? It depends on my risk taking capacity. People, those who are more risk averse, they'll keep more and more cash. And people, those who are ready to take risk, they will go for investing in the market. So Tobin said that individual behavior towards risk aversion decides about how much they want to keep money as safe and how much they want to invest in risky assets. Because any asset you name has some component of risk, and that is why you derive returns through that. So to what level, to what extent people are ready to take risk, that depends on individual behavior and the risk appetite. More risk averse people will go for taking less, so that prefer less risk to move risk at a given rate of return. To make people, those who are highly risk averse, to make them invest in the market, what has to be done? Rate of return has to be offered at quite substantially higher rate, isn't it? Suppose I am the one who's not ready to take risk. What will I do? I'll keep more cash. And if government or the financial system want people like me to invest in the market, what they have to do? They have to offer return which is more stable and substantially at a higher level. Then only it will motivate me to go for investing. So Tobin decided about the behavior based on the risk appetite of the players. So this is how it varies. So in the Keynes analysis, what we have shared, it talks about nominal income. It talks about wealth of the people only in bonds or in cash. But Tobin spoke about behavioral aspects, safety and risk-taking capacity of the people, which decides about what proportion of financial assets they should have and how much quantum of money they should keep in cash. So this is how this theory varies. So Tobin, I've already shared, individuals are uncertain about the future rate of interest. What will be the returns we will be getting? If I invest in stocks, what will be return I will be getting in future? If I invest in bonds, God knows the returns will be higher, interest rate will go up or down. That refrains me for investing. So more the uncertainty, higher is the price which is involved. So if wealth holder chooses to hold a greater proportion of risky assets, such as bonds in his portfolio, he will be earning a high average return, but will bear a high degree of risk also. So Tobin argues that a risk avert will not opt for such portfolio with all risky bonds or greater proportion of them. So people, based on their risk appetite, that's why you see that why do we say that depth of the financial market matters a lot? Why we say depth of financial market matters? Why in India stock market are so volatile? Why they're so volatile? Because the investors, domestic investors, are not that much. It is mainly governed by speculators. Why domestic investors are not that much in the market? Because they have a low risk appetite. If you have a low risk appetite, then you do not want to add in your portfolio risky assets. And since you do not want to add risky assets in your portfolio, you will keep more currency. And if you keep more currency, that means you incur more cost. And you will not be ready to take risk. At the same time, you won't get any returns. So if this is a scenario, then what will happen? You won't have acquisition of wealth. And if there's no acquisition of wealth, then in that case, the country economic growth will not happen. So it's very, very important that financial products should be so defined that people should take risk also and should have assurance. So such kind of people, those who have a low risk appetite, where will they invest? They'll not invest in bonds. They will not invest in capital market. They will go for putting their money in bank deposits. In such cases, people will go for low returns and they'll go for safe investment options. And that is how the decision to make their portfolio depends, according to Tobin, depends on what? Risk appetite of the players. So how Baumol and Tobin's concept vary? Baumol said what? To create portfolio. And Tobin said that portfolio creation is not based on returns on assets, it is based on risk appetite. Higher the risky assets you have, higher the returns you expect, but at the same time, uncertainty is also higher. So if you do not have, if you believe in safety and reasonable returns, then you have to strike a balance. So here, what Tobin is proposing, the balanced portfolio. What kind of balanced portfolio Tobin is proposing? He is proposing a balance between money, which is safe, obviously, and riskless asset, and risky assets. It may be in the form of bonds, it may be in the form of shares, but you have to go for a combination of these in your portfolio so that you can minimize your risk and at the same time you can reduce your opportunity cost of holding cash, and you can get returns also, you can create your wealth also. So money demand in the case of Tobin's context depends on what? Risk appetite. And it varies from individual to individual, their attitude towards risk, how you perceive risk, how comfortable you are in terms of trade-off between risk and returns. How do you balance between these two? Okay, so Syed is saying that Baumol's theory is more applicable than Tobin's theory in global economy. I tell you, Syed, it depends on who are the category of investors you have and how developed the market is. For example, I say that if the financial institutions are well developed, and have you done this concept of market failure? You've done no asymmetry of information. You've done asymmetry of information. So if you talk about asymmetry of information, if you can recap the concept of asymmetry of information, what banking services or the financial institutions can cater in terms of their product and services, and what kind of risks do they have, what kind of return they can offer, and investors, they are aware about it. So if both of them are aware about it, then in that case, absolutely. In that case, what is going to happen? The probability of market failure will be minimized. And since the market failure will be minimized, people will be investing more because they know about risk. What is the risk? They can define risk. Like you see what happened in the case of cryptocurrency. Who invested in the cryptocurrency? Who invested in the cryptocurrency? So there Tobin is more valid, isn't it? So Tobin is more valid in the case of cryptocurrency because people, those who had a high risk appetite, they invested in cryptocurrency. But people, those who had a low risk appetite, they kept cash. They were not finding it lucrative, the returns which people thought about getting in short go from this cryptocurrency in the market. So it depends on context which is more valid. You have to fix it up. So what is your take? Anyone here can share their views regarding that which theory is more. Acha, you didn't invest. Good, Jaspreet, you didn't invest. Very good. You are sensible. So Tobin derived his liquidity preference. You remember we had shared Keynes' concept. Keynes had given 3 money demand categories. One was about transactive motive, precautionary motive, and speculative motive. And these were all based on the basic principle of liquidity preference. Liquidity preference means how much cash you want to keep. So more and more cash you want to keep, that means more liquidity preference you have, isn't it? So in this case, Tobin said what? Tobin derived his liquidity preference function depicting relationship between rate of interest, which is expected rate of return, keep it in mind, and demand for money. So how much money you want to keep it and how much wealth you want to create. And that's a trade-off between the two. So what is the core of Tobin's? Tobin core is rate of interest. If the rate of interest will be high and market will be more safe, Why not? People for sure will go for investing in the market. And if people go for investing in the market, that means they are going to keep less cash holding. And if they're going to keep less cash holding, that means the money is going to be invested in the market, which will help the players to invest back, and the corporate will be doing very well in that case. So this is money demand concept and money demand theories. Now to recap, if you want to ask anything, you can ask. Otherwise, I'll go for recap and can take your queries if you have any queries. Regarding your question paper, what kind of questions you can be asked? Expected rate of return interest is the core of this theory. Absolutely, absolutely. So you want me to recap things? Shall we go for revising it once before we wind up for the day, so that trade-off, Pranav, trade-off is trade-off simply, if I tell you, you have two options. To study by your own, or to study through this virtual learning platform. If you study by your own, then you can study at your own choice, at your own pace of time. But at the same time, you have to devote more time, I believe, for getting. So trade-off is that, shall Pranav go for studying online, offline by himself, or should he go for taking classes? What is the cost of taking classes? What is the cost of not taking the class Pranav has to forego? Is a trade-off. So life is a trade-off. If this, then what I'm foregoing. If this not, then what I'm foregoing. That is a trade-off. So getting one at the cost of other is trade-off. Got it, Pranav? So let's just recap. If you have any other query, you can ask. I'm waiting for your queries. If you have, you can ask. Okay. So to write answer of any question, Sayed, is the best way is to explain in your own words. If you go for literally copy paste from the module to your answer sheet, that means examiner will come to know you are a rote learner. You do not understand basic. And I tell you now, the way of assessment has changed. It is not about what is written in the book. You just have to copy it down. You will have scenario-based questions or caselet-based questions where you have to think and analyze. Like we have shared 2008 crisis and liquidity trap. So you can write in your own words in a simple manner, but the essence of the answer should not be lost at any cost. That is how. So nobody is going to give you, at least in economics, I can tell you that in economics, you will not lose marks if you're not going for copy paste word to word from the module to your answer sheet. You can always write in your, and rather I would suggest you should always write in your own words, because you will write by understanding it and you will frame your answer in a better manner rather than simply quoting it. When you go for copy paste, then you literally learn it by heart and then just write it. Here you are going to understand, and once you understand things, it becomes easy to frame your answer. So I would suggest that you start referring to your module as a reference point, but frame your answers in your own words. That will help you a lot. So yes, Sayed. Trade-off is opportunity cost. Yes, definitely you should use pointers. Definitely you should use pointers that will help the examiner also to come to know that yes, this child knows about everything, because pointers makes things crystal clear. And write small sentences and differentiate one point from the other. As interest increases and investment increase, so there is a direct relationship. See, Pranav, when interest increases, investment, who increases investment? We people increase investment because the opportunity cost of holding cash goes up. So that is why we invest. And that is why money demand in the economy will decrease. Yes? So any other question if you have? I can take your queries if you have. Whatever we have shared today, any doubt you have? Anything you want to ask? So simple numerical can be there, MV is equal to PT. So MV is equal to P by, MV is equal to P by, and this is also written as PT. PT is price and transactions. Yes, so they may give you, these are four variables, no? MV is equal to PT. So they may give you money supply, they may give you the velocity, they may give you transaction, and they may ask you about the price level. So you can do it. That these are simple questions which are there. Then the question, one question was there related to liquidity trap. So how liquidity trap you can share. Then the question which was about related to this cash balance approach. So cash balance approach also you can write about what is cash balance approach. I hope it is clear to all of you. There was a question on this transactive motive. So these are a few questions from the money demand chapter. More you will have when we'll share about money supply and others. Performer type? No. Performer type something to answer scenario question. Yes, performer type. Yes, performer I can share. For example, we have shared bond price and interest rate. Okay, so for any scenario based question, what should you do? You should write what is the theory behind it or what is the concept behind it, and then frame your answer. So first write the theory behind it, what is the core concept behind it, and then explain your answer. So if you write straight first and the foremost thing about what is the theory underlying that or what is the concept underlying it, and then you write your answer, you are halfway through. You're halfway through before you go for attempting the entire. So examiner, before going through the entire answer, will come to know about this child knows about the concept very well. So if you identify, sometimes it can work against you also. So if you are overconfident about that, this scenario is based on this particular concept or theory, and you frame that, and if it is not, then you will lose entire marks. So be very cautious about, if you are not 100% sure, then do not mention it straight. So you have to act very smart when you frame your answer, isn't it? Because you cannot take that leverage by writing something which is not absolutely correct in a very first statement, which may go against you. So, and this may not happen if you have done your homework very well in terms of knowing the concept and theories behind it. So I would say that you people start making some pictures in terms of images. So images that money is one boy or a girl, and then there's Tobin, who's talking about to that money in terms of money demand, that why money is why you are required. So this way, if you start connecting, things will be very easy, and you will retain it all throughout your life. You will never forget about it. And start differentiating. So we have shared different theories today. Make a table and differentiate one theory from the other theory. What is the differentiation between one theory with respect to other? And keep that table with you so that last minute when you have to prepare, you just refer to that table and you're through. Okay, so any other query you have, you can ask. So we started with basics of money, why money, we switched over to money demand. We shared about what is the relevance of money demand theories, how the money demand varies with respect to three core variables, that is interest rate, income, and price level. Then we shared that money demand can be based on core two parameters, that is exchange value and store of value. Medium of exchange, which was given by classical economists up to Keynesian economists. Keynes took care about store of value in the last precautionary motive. And then later, if you see, they have spoken about store of value as well as medium of exchange. So that is how transition has happened over the period of time. Any other question, if you have, you can ask. Before for the day. Any other question, if you have, please do ask. So shall we wind up for the day? Okay, then thank you. Take care, all of you. Bless you all.